Hi everyone, welcome back to another episode of Providend's Money Wisdom Podcast. I'm your host, Isaac, Associate Advisor at Providend. Join with me today is Lim Choon Siong, who is our Investment Research Analyst. Hi Choon Siong.
Hello Isaac, thank you for having me here.
No problem. So in a blink of an eye, the second quarter of 2023 has come and gone. So as promised, we will be doing our market review of the quarter that has just passed. So Choon Siong, how did financial markets perform the past quarter?
Well, Isaac, the S&P 500 for the second quarter went up by 8.6%, MSCI World about 6.5%, MSCI All Country World 5.9%, and the MSCI Emerging Market is about 1.7%. So you can see overall the broad index did well for the second quarter. S&P 500 did exceptionally, which helps MSCI World, that reflects the developed market, to do better than the MSCI All Country World, which comprise of both developed and emerging market. Now, emerging market was also positive for the quarter, but did not do as well compared to the developed market. Part of the reason is likely attributed to the Fed's signal to keep interest rate higher for longer to curb sticky inflation, which drove up the US dollars, which means that emerging market weakens relative to the US dollars. And this means that the emerging markets that issue denominated US dollar denominated debt will need to service a higher debt. Now, as a result, they seem more risky.
Right, Choon Siong, so what were the catalysts for the biggest moves?
There were a few big factors that moved the market in the second quarter. Some were ongoing concerns that continued from last year, like inflation and higher interest rate, and more recently, worries of a systemic crisis spreading after a few US regional banks collapsed. So we also have a US debt ceiling issue, but the ceiling was eventually lifted by the end of the month. What drove the biggest moves in the market, though, is likely the AI optimism and US megatech's strong quarter one earnings that was released in April. Well, I did a rough calculation. The big tech companies, to name a few, like Nvidia, Apple, Microsoft, Alphabet, Amazon, Meta, their average rise in the second quarter was about 44%. And in the S&P 500, the weight allocated to these companies are about 28% in total. For the MSCI World, their weight is about 18.5%. Now, the higher weight and strong performance have been the main catalyst for the positive performance in the second quarter.
Right, so another significant event that happened in June was that the Fed opted to pause rate hikes. So was this a shock to markets, or was it something that was already mostly priced in?
Well, in their June monetary policy meeting, where they decide on the US interest rates and their expected future interest rates, the Fed has signaled that they are likely to hike rates for another 50 basis points, or 0.5%. Well, because core inflation has been sticky because of a strong labour market. If this remains the case, they will likely follow through and hike rates. So from this perspective, we are not really seeing a pause, but a skip.
Right, so far in 2023, as you mentioned, the market rally has mostly been growth-led. But we have seen value outperforming growth in 2021 and 2022. So, in your opinion, do you think that growth stock rally is something that can be sustained? Or is it just a bounce back from badly beaten growth stocks? As we know, growth stocks didn't do very well in 2022.
Can't say whether this rally can be sustained or not. Well, it ultimately depends on what the market thinks of their earnings as well as their actual earnings. Growth stocks have a higher price relative to their current earnings because they are expected to have a higher growth in earnings in the future. Last year, when interest rate and yields rose sharply, growth stocks, which has a higher weight in expected future earnings, fell sharply because of a higher discount rate. In other words, the current value of their future earnings is lower. On top of that, some of these growth stocks missed earnings expectation during that year, like Meta and Alphabet. This year, they rebounded because these companies have strong earnings. The market prices in this information almost simultaneously. And saying growth stocks can or cannot be sustained, it's sort of saying that I have more information and therefore a better value estimate than the market.
Right. So FANG stocks, more specifically Meta and Netflix, as you mentioned, had a huge increase in their share price in 2023. So back in 2022, the Russell reclassified Meta and Netflix from growth to value when their stock price plummeted. And now I assume that, with their huge stock price increase, they will be classified as growth stocks again. So if you don't mind me asking a more technical question, especially, we use a systematic strategy that tilts towards value.
Yep.
And in the context of dimensional methodology, how did they deal with the stocks migrating from growth to value and back to growth again?
Well, thank you, Isaac, for that question. This might sound a bit technical, but whether a stock is a growth or value stock tells us something about its long-term expected returns. Now, so does its size and profitability. Momentum and securities lending, on the other hand, tells us something about the short-term expected returns. For example, if you lend out a stock at a high rate, it means that the cost of borrowing is high. And this cost of borrowing contains information about short-term expected return. A high borrowing rate indicates a lower expected return. Managing portfolios is a matter of weighting the long-term drivers of expected returns like size, value, and profitability against the short-term drivers of expected returns, momentum, and securities lending. And dimensionals know that to build a portfolio around the long-term drivers, and at the same time, they will use the short-term drivers to help them determine when to invest or divest them. Now, that being said, just because a stock has gone from growth to value doesn't mean that dimensional will automatically increase allocation to that stock. They still want to weigh the other long-term drivers such as size and profitability. They want to consider there are many other stocks they may have higher expected returns because they are smaller, more value, or more profitable. So there are many things to consider beyond the stock simply going from growth to value. Now, of course, another thing to consider, is if it's a core or value strategy that holds the stock. If it's a value strategy, they will look to sell a stock that has moved from value to growth category because it no longer fits the intended asset class of that portfolio. Now, if it's a core strategy, they can have more flexibility because the strategy can hold both value and growth stocks. Meta is currently considered to be a large cap, moderate value with strong upward momentum and high profitability. When it became cheaper, it had lower profitability and very strong downward momentum. So, Dimensional didn't load up on it. They only started to buy more when the downward momentum wore off. Now, Netflix is currently a large cap, moderate growth, low profitability, and moderate upward momentum. Not characteristics that they are looking to load up on. Okay, I'm going to quote unquote, what would be bad investors in terms of behavior? A so-called quote unquote bad investor might sell Netflix and Meta when the prices go down because the news suggests things are bad. And they might therefore wait for better news to get back in when things look clearer. And then when the news does get better, the price become higher than the price they got out at. And they sit on the sidelines not knowing what they should do next. So in contrast, Dimensional uses a systematic process to weigh many different factors, long and short term, to help manage expected returns in a broadly diversified portfolio while managing costs to be as low as possible.
Well, so let me try to summarize what you just said because it's very technical. I was taking a while to really internalize that. So, in a practical sense, so let's say for Meta and Netflix, we saw a huge drop in stock price in 2022. Obviously, after the downward momentum has dissipated, deep dimensional pickup, let's say Meta stocks, and when it became something that is more value, for example, in terms of let's say a global core equity fund, did dimensional increase their weightage in Facebook when the downward momentum dissipated?
So last year, when Meta fell and moved from growth to value, dimensional did load up on them because they have higher profitability.
Right. So when we look at it, it's as true to their name, they take a multi-dimensional approach. So they don't just look, if a growth stock becomes value, they don't just start loading up. They'll take into account different factors like momentum, profitability before they make the decision. It's just that for this specific case of Meta, their stock price fell last year, but because they still have strong profitability, so there's two dimensions that is favorable to dimensional to pick up more of that lah. So that's why we see that when there's a migration from growth to value, like the example of Meta, and when you look at the other factors like profitability, etc., it's all something that is in line with dimensional's approach. We can see that dimensional will actually buy more of those stocks. So now that we have seen the stock price soar, almost I think it's above triple digits return this year for Meta. So how would dimensional treat stocks like that? That went from maybe, like you mentioned, moderate value. Let's say hypothetically it's a growth stock again. So how would dimensional deal with this migration from value to growth?
Well, in fact, currently Meta is actually still considered to be moderate value, but let's say that Meta has now become growth from value. So what would happen is that, depending on other factors, for example, like momentum, if there is an strong upward momentum, they would probably keep holding on to the stock first, and until that momentum dissipates, then they will have a lesser weight on that stocks.
So in summary, if let's say a stock goes from growth to value and back to growth again, we have to consider that there are still other factors as well in terms of momentum, profitability,
Securities
the size, right? So let's just say ceteris paribus, everything all else held constant. If a growth stock becomes value, dimensional will wait for the momentum to dissipate. They will pick up more of those shares, and vice versa. Like when it becomes value to growth, you wait for the upward momentum to dissipate, and then they will start to cut on that position lah. So in essence, is that what dimensional is doing? I know it's a bit more complex than that, but let's just assume that all the other variables are constant. Is that the gist of how systematic investing is?
I would say that what you summarize is pretty much in a more generic way that simplifies it, yes.
Right. Okay, so let's talk about artificial intelligence. A lot of the recent rally centered around AI stocks, as you mentioned earlier. So the most prominent one being Nvidia, which saw its share price really skyrocketing this year. So what's our take on this sudden AI hype? Like, does it make sense to chase this trend?
The short answer is no. At Providend, we believe in holding a globally diversified portfolio to capture market returns. Essentially, what capitalism owes us in a way, and do not believe in forecasting. Now, from time to time, it is inevitable that we see certain trends or price spikes in a certain select group of stocks. Now, dating back from railway stocks in the 1800s, airline stocks, to more recent times such as internet stocks, and even marijuana stocks, electric vehicles, and now AI, right? Now, empirically, we see no evidence that chasing these trends provide a reliable, good outcome. And history has shown that they tend to come and go without providing reliable returns to the investor.
What do you mean by reliable returns? Like what does, at Providend we always say reliable returns. What do we actually mean by that?
Essentially, it is like betting on the trend. Betting on the trend is like rolling a dice. In fact, investing in a diversified portfolio for a longer time period increases your odds of success. Much like how the house in the casino usually comes out ahead. When you are invested for the long term, you are able to ride out short-term market fluctuations and benefit from the overall growth of the market. Over time, the stock market has historically shown an upward trend, allowing patient investors to capitalize on the growth and potential profits. Now, on the other hand, chasing trends and constantly buying and selling stocks based on short-term market movements is similar to gambling in a casino, right? It's risky and often leads to unpredictable outcomes. Trends can be fickle and difficult to predict accurately. So by taking a long-term approach, staying diversified and invested, you position yourself more like the house in the casino, increasing your odds of success over time.
Right, but some people will say that, what if I invested in Microsoft during the internet bubble? I mean, Microsoft offices all around the world, everyone is using Microsoft. Investors in Microsoft, I'm sure they have received outsized returns as compared to the broader market. So what if these trends do work out and change the world?
Good question. There's always a chance that a stock you buy turns out to be a Microsoft of the internet bubble, whereby the investment has exceptional returns. However, it is more survivorship bias more than anything. There are thousands of internet stocks during the boom, and even stocks that look fundamentally better than Microsoft during the peak of the bubble also had very poor returns. Trendy stocks tend to exhibit high prices with future earnings projected way into the future. These high price stocks, we can also call it growth stocks, do not have a high expected return in the long run.
Right, that's very comforting to hear for our listeners. I mean, like, as long as you are invested in a globally diversified portfolio, don't start chasing trends. In the long run, you can expect market returns to achieve whatever financial goal or life goals that you have set out. Whereas if your strategy is to chase after trends, there is always a good chance that you might get burnt and not achieve the goals that you set out from the start. Lastly, what should we as long-term investors do in these market conditions?
The market is always on an ebb and flow. What I mean is that there are times when it is inefficient, when there is new information that just came in. But the market quickly incorporates this information inside. Like I mentioned, by using market timing or investing in a few stocks which you think the current price is lower than its fair value, you are sort of saying the market is strong and I'm right. And what are the chances of you being right? The best way as a long-term investor has always been to stay invested in a diversified portfolio. And depending on your need and ability to take risks, you can either invest in, let's say, a 60-40 portfolios of stocks and bonds, or you are able to take more risks because you're at a younger age, for example. You can invest in 100% of stocks. Now, let's say if you're able to take higher risks and invest in 100% of stocks, holding a diversified equity portfolio would likely be better than holding a concentrated amount of stocks because of the reasons I mentioned above. That is very difficult to be more right than the market. Now next, imagine a 10-year risk-free bond that costs $100 and a unit of ETF that tracks the market index that also costs $100. Which one has a higher expected return? The market, right?
Yeah.
The bond, let's say, has a yield of $2 every year for the next 10 years, and at the end of the 10 year, you get your principal back. Do you think your expected return for the unit of ETF be higher if you sell by the end of the 10 year? And why? Now, yes, it will be higher, but the expected return is less certain than compared to the bonds. Yes, in certain years, you can see that the market is negative. But if you look at historical data, for 50 years, 80 years, you will notice that the actual returns will be substantially higher than a risk-free bonds. That's why, based on empirical evidence, the best strategy for a long-term investor is to stay invested in an index that proxies the market.
Right. So as always, to summarize what you just mentioned, if you have a long enough time horizon, you have that risk appetite. Just sit tight, stay invested. Because as you mentioned, there's a higher expected returns for equity portfolio as compared to a bond portfolio. Okay, so that's all for this week's episode. I hope you all enjoyed our Q2 market review. If you like this episode, follow our podcast and follow us on social media for similar contents. As always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.